Welcome back to First Up, your first up on a busy Tuesday morning. Right now we switch focus to the financial sector, and we have our friends from the Unit Trust Corporation to give us their usual good advice on how you can make your money work for you. And to help us through this segment, we have our Vice President, Investment Management Services, the Unit Trust Corporation, Mr. Kriss Marcus. I almost gave out your telephone number there. And Manager Sales and Promotion, Unit Trust Corporation, Omar Holder. Guys, welcome back to First Up.
Welcome.
Thank you very much.
Good to have you.
The global situation, people realize, impacts us all. And as your company does, is wade through the issues for us as, to me, one of, if not the most credible financial institution and stable in the country, to make sure that the global situations do not impact us negatively. Do you see any global events and activities that may affect investment performance locally?
Well, yes. Right now, our team is, for the most part, looking very much at QE2, the conclusion of the QE2 program, essentially, where the U.S. Fed has been embarking on a program to inject money into the financial system by buying back its treasury. Quantitative easing. Yes, essentially, the government of the United States has embarked on a program where it is they buy back their debt securities on the market in an attempt to create an injection effect. So that those funds essentially chase the stock market by virtue of what happens on Wall Street. America is the home of capitalism. Wall Street is the home of capitalism. So Fed policy is essentially designed to defend the stock market, and as a consequence, with the opportunities for investors, both internationally and locally, will present themselves in those markets. The oil situation is one that is also being monitored very closely, largely as a consequence of the volatility coming out of Libya. There was a rally 2 weeks ago with the death of bin Laden, and as a consequence, we have seen some movement in the oil prices upward. So yes, there are opportunities, especially in a context with companies like that, where companies that are oil producers typically would try to benefit from those from the movement in energy prices.
Does the big buzz within the U.S. now in the political circle is U.S. debt, $14 trillion. Yeah. Does that impact us in any way, or how can it impact us?
Ultimately, you would see if there's a deterioration in the credit quality fundamentals of America, there will be a trickle-down effect. Essentially, you have widening of credit spreads, as they refer to, in terms of the borrowings of other countries, that would have U.S. dollar-based lendings and borrowings. So, in the circumstances where there's a perception of a deterioration in the credit quality of the United States, you would find that there will be a trickle-down effect for weaker economies. So Trinidad and Tobago is not going to be insulated from that. And that in the event that there is a deterioration in the credit rating of the United States, you would find that you would find a trickle-down effect. So it is something to monitor.
Okay, Kriss, let's be blunt. Let's talk plain talk now. Is war good for us or bad for us? Because we see what's been happening with Libya. We saw what happened with Iraq and Afghanistan and those other places. Libya, the most recent theater that's opened up. Is that good for us or bad for us?
It is going to be how it is we interpret war. War in the circumstances, and allow us to be self-serving here, where it is we have an energy fund, where there's always a threat of scarcity or lower production. It can lead to a situation where oil prices improve. Our energy fund is based and built on companies that are energy-based, and oil in the circumstance where there's a threat of shortage. As we have actually seen over the last couple of weeks, the oil price has gone up to, I think it reached a high point of $113.93 a few weeks ago. And that has had a positive impact on our mutual fund and the energy fund. The energy fund, if you had invested in the energy fund at the beginning of this year, you have experienced a return of 7.41%.
Seems to make your heart skip a beat.
Yes. Again, the volatility has to be interpreted, and most importantly, we have to actually know exactly what is the best strategy to employ once we see volatility, and move forward from there.
Omar, in terms of your position as manager, sales and promotion, for the lay people, I mean, we just want to maximize our investment. and there's so much information coming at us, 24-hour news networks, information in the newspapers. How can we manage this information overload and really zone in on what is important for us as investors?
Very good question. Stick to your goals. That's the number one thing we tell investors. You have a plan. You need to know what you want from your investments and when. Some investors come to us and say, I would like to save. That's a start, but you need to be a little bit more specific. Identify exactly what you're saving for. So is it a house, a car, a piece of land, putting your children through school? And most importantly, attach a time frame to that goal. Reason being, if you would like to get a house next year, the 10% down that you need to save for the house is going to have to come a lot faster. You're going to have to put out a lot more money. If it's 5 years from now, then you can take a little breather.
So you have to prioritize.
Correct, exactly. And most importantly, yes, the pundits and the experts say all that they say. So you don't disregard them, listen to them, but they are not in where you are in your life at that point in time. So you have to stick to your goals and make sure you know what you want.
Do people understand that that sort of financial discipline is really their friend? Because some people say, oh, gosh, I want to play mass. I want to go on a trip. I want to go to Jazz and Tobago. And they don't realize that, you know, you need to set your goals, set time frames, and realize, well, sometimes I have children going to college, kids going to college. I need to realize what's important to me down the line and set a time frame.
Correct. Some people do, and we are seeing that more and more are becoming more financially aware, particularly in the planning process. At Unit Trust, we seek to continue that. We give free financial planning seminars throughout the length and breadth of Trinidad and Tobago to help people do that. But we are seeing it more, I think, because of all that has happened in the financial landscape. People are realizing that if your child is now 3, you can't wake up in the morning of their 18th birthday and then start to save. You have to start now.
Or even their 15th birthday.
Or even the 15th, exactly. Earlier is always better.
Just looking at the whole, you know, savings and investment environment, you say that more and more people are becoming disciplined where this is concerned. They're trying to become savvy with their money. Given the little shake-up that we had over the last few years, more and more people taking out loans now? Are they putting more money in investments? Are they able to put more money into savings? Or have you seen, you know, those figures reduce somewhat as people try to juggle all their responsibilities, face the reality that they probably won't be getting a salary increase anytime soon, and cost of living very, very high? Yeah.
When compared to the period just before the financial crisis, if you were to do a statistical comparison as to the lendings and, well, loans from banks, the lendings have significantly reduced. More importantly, people are not borrowing. I think there's an air of caution that is still very much prevalent in our market as a consequence of all of these shakeups. That being said, people have been in fact going after what can be referred to as the safe assets locally. For example, I've seen over the last couple of months a significant increase in our second unit scheme, the second unit scheme, and essentially that fund tends to typify the risk profile of the average Trinidad and Tobago investor. So it's no surprise that we are seeing it moving, it increase by some $250 million.
So people are looking for sure things.
People are looking for safety. They're looking for safety. At the same time, they want competitive returns. They want to be able to move in and out of an investment.
Speaking of safety, I mean, we've had the recent domestic situation of the demise of this giant financial institution. And the stability of the Unit Trust Corporation, no doubt, would have been a factor in people deciding, you know what, that didn't work. There was some mismanagement there. It fell through. Has your company benefited from that? Because, I mean, your stability, you've shown your stability, you've shown your worth, and people would have now been wanting to move what they can from what they would consider unsafe areas to more stable areas.
Well, the benefit is twofold. Yes, funds would have come into us as a means of trying to look for safety, but it also gave us the opportunity to talk to our unit holders about risk and return and the implications of certain types of investments. Some schools of thought will say that for you to win big, you must be prepared to lose big. But we don't want to hear that in our environment.
That's what gambling. This is not gambling.
Correct. Exactly. And as a consequence, people tend to want to preserve their money. And the opportunity certainly presented itself in terms of us being able to talk to investors, understand the relationship between risk and reward, and as well as the highs and low points of markets, especially in light of what you would have seen in the last few years. That being said, the opportunities have been presented themselves, yes, and we will just try to do our role in terms of continuing to educate the public, understanding their role as investors and exactly what responsibilities and disciplines go with investing.
Omar, what would you say are the three main investor profiles?
Definitely persons who are risk averse, persons who are willing to take on some risk, and then persons who are aggressive in their risk profile.
So it's all risk related.
It's all risk related.
In terms of the people's profiles.
Correct. And I think persons, the bulk of investors we meet are persons in the middle who are willing to take on some risk, and they're willing to take a chance, not too much of a chance, but they're looking for instruments that can provide that balance of risk and return. It's interesting that for a lot of our investors, when we speak to them and we ask them, well, how do you manage risk? People will say, I don't have all of my eggs in one basket. And we're recognizing more and more that while diversification is important, you have to ensure that diversification is true diversification. For example, investors tell us, well, I have a unit trust $TT income fund, and I have a $TT income fund at institution X and another $TT income fund at institution Y. Unfortunately, that's not true diversification, because you actually have the same type of investment, just at different institutions. Exactly. So to ensure that you are mitigating that risk, you need to balance your portfolio, have some in stocks, have some in bonds, and there are a variety of instruments.
What about people who say, you know what, I don't have all my eggs in one basket, meaning the institution, but they don't realize that having it in the same type of portfolio is where the real risk lies, because no matter the institution, it's going to still come like you, bam, if that particular
doesn't perform as well. Exactly, that is true. And to start to help in that way, we tell people that when you're looking at your goals, make sure your goals are matched to the right funds. So if it's a short-term goal, you match it to a short-term fund like the $TT income fund. A long-term goal, match it to a long-term fund, the growth and income fund. So that way you will have the balance.
So it's not that you're trying to grab all the money. You just want them to be really and truly diversified.
Correct.
That's correct. Yes.
Exactly.
Yeah.
Exactly.
Let's look at how the funds have been performing, you know, given what's happening on the international scene. And the ones that have been performing well, where should people really think of you know, putting their money, because they're probably thinking, okay, I want something safe, I want something stable, but I also want something that's growing really well, that would give me great dividends. So let's talk about that for a bit.
Well, credit is due a lot to the financial professionals that work at the corporation. I mean, they're a very strong, dedicated team, and they have mastered the art of interpreting information and making the correct decisions. We've seen it in the fund performance. And again, if you had invested in any of the funds this year, I can refer to the flagship funds, the TT Income Fund, the US Income Fund. Those funds give you a guaranteed return. The Growth and Income Fund is up 4.1% as at last month. So the flagship funds essentially take care of themselves. On the international side, essentially the funds that would be more in tune and more sensitive to international events, like the Energy Fund and North American funds, those funds have been performing very well. The Energy Fund, as at last month, is up 7.41%. The North American Fund is up 5.1%. And again, it speaks directly to those issues that we spoke to last week, a few minutes ago, as far as the QE2 and the energy events. So, having said the issue and having spoken to the issue of the volatility and international events, we have been able to translate our interpretation of those events into good performance.
Looking 5 to 10 years down the road, the medium to long term, are we seeing any trends in terms of where people should be starting to look?
Again, It has to do with what you want to achieve as an investor. Yes, depending on where you are in the time horizon. You may be a young person, just started work, you just finished secondary school, university. You may want to look at some growth, but at the same time, you want to save at the same time. Another person lower down on the spectrum, somebody who's approaching their 50s, 40s, retirement planning is a focus on preservation of capital. So again, it is going to be what you want to achieve. So there is no hard and fast rule. It all depends on what the investor wants to achieve, where they are in their life cycle, and from there you make your decisions. But again, it has to be a disciplined approach.
I mean, I'm 28 years old. I've just finished school. Now started to work, and just looking to get married, buy a house, and my salary is $7,000 or so. What would you advise me when I walk into the Unit Trust Corporation? I have no kids yet. Just going to get married in a year. Want to buy a house. What would you advise me?
A good mix of that. At that particular stage in life, we give investors a tip. Take your age, add a percentage sign to your age, and invest no more than that percentage in what we would call the fixed income instrument. So at 28, 30, you want to put about 30% of your investment into a fixed income instrument. Why? At that age, you have time to ride out the ups and downs of the markets, and you are really preparing for the future. So the bulk of your money should not be in a place that is easily touched. Yes, you still want to go Zen, Lime on the weekend and so on, but all of the money should not go there. So the bulk of it, 70%, should go to things like the Growth and Income Fund. As you said, getting ready for that house. I'm getting ready for the children's education. And as you start to get older, the profile is going to flip.
All right, so I'm 45 years old now.
Right.
I have my house.
Correct.
I'm married. My kids are like just getting ready for university.
Exactly.
What should I be looking at?
So you increase the amount that goes to your income fund. Why?
45%.
Correct. Exactly.
Trying to get to 50.
Right. Correct. And why? Because at that stage in life, you have to pay more fees just now. Somebody's most probably lower down in primary school. You have to pay a mortgage.
10 years, 15 years left on the mortgage.
Exactly. So you need extra money in your hands, but still, life is happening in the future, getting close to retirement and so on. So the other half of the money still going to something that will provide some growth. As you start to get older now, getting ready to retirement, say about 60, maybe going in 5 years, maybe going next year, the bulk of your money now needs to be in a safe place. Why? You no longer have a paycheck. You need the money to be accessible, and you can't have those ups and downs in the bulk of your portfolio. But still, at 60, most people would be on the planet another 15, 20 years. Particularly if a lot of people in your family are elderly. So you have people, your parents, grandparents went into their 80s, 90s. You now have to protect yourself even longer. So that balance, age is a good guide of how your portfolio should be split.
We basically run out of time for today, but the bottom line is prioritize, be disciplined, and stick with your plan.
And diversify.
And, yes, and diversify.
Correct.
Okay.
I like that. Prioritize, stick with your plan, and diversify.
That's exactly it. Okay. Finally, before we go, we just like to invite all our investors to our annual general meeting next Tuesday, 5 p.m. at Queen's Hall. And this year, for those people who can't make it, we have a special live stream on our website, Facebook, Twitter, so you can see everything that's happening.
Fantastic. Thanks very much, Omar and Kriss. We look forward to seeing you guys in a couple of weeks again. Okay, we're going to go to the newsroom now, get the latest, and come back with more on First Up.